Our next guest joins us with a look at bank stocks. The sector starts reporting quarterly results next week, so here we go. Get ready. Joining us to talk about it is Scott Siefers. He is bank analyst at Piper Sandler. And Scott, what's your overall take for the banks? What are you thinking? Because there's so many moving pieces this time around.
That's right. Hey, Becky, thank you for having me. So I guess to start, I mean, we really couldn't be more thankful to close the book on 2023, but it's amazing what a sea change we've seen in the past couple of months, just as the rate outlook and the macro outlook has changed. So, sort of amazing what lower rates and a soft landing, or at least the prospect for them, can do to things. So it sort of feels like a lot of those 2023 investor concerns in a lot of investors' minds have either vanished or kind of reversed. So, unquestionably, we're in a better place than we were throughout much of last year. In a perfect world, we'll sort of get this Goldilocks outlook and that the market has embraced, and we'll somehow avoid a recession and get to cut rates aggressively. So I'd say we're not completely out of the woods. A lot of the outlook for the group is ultimately going to hinge on whether or not we can avoid this slowdown and avoid a more visible recession. But in terms of what we'll be looking for with earnings next week, I think we're hoping that NII and net interest margins will bottom. We're probably not going to hear anything really good on loan growth. Ideally, the capital markets will be kind of primed for a turnaround. And then I think everybody's watching expenses very, very closely, given the still tough revenue backdrop.
Having said that, I know you've got an underweight on Bank of America, a neutral on Citigroup and Wells Fargo, and an overweight on JP Morgan. You want to explain why?
Yeah, you bet. So JP Morgan, that remains just a best-in-class name, unquestionably. They're one of the few names to have come out of last year's turmoil in a much stronger position. And we think as we look into earnings, they've got a very, very conservative NII or overall revenue guidance. And as time kind of goes on, either they'll be right and the rest of the industry has been too ambitious, or JP Morgan will be wrong and they'll actually have to lift their guidance. So in a sense, they end up winning either way. So what you have is a name that's really well positioned for basically all kinds of outlooks, and you still have a defensive play in it as well. Typically, JP Morgan is the one that kind of sucks all the oxygen out of the room. When we have all these big four report on the first day of the season, everybody's eyes are always on JP Morgan. Kind of feels like, based on the investor feedback that I'm getting these days, Citi is the one that everybody's going to have their eyes on. I think what has sort of happened is everybody feels a lot better about the group than they did even, call it just 2 or 3 months ago, but they're having trouble identifying individual names around which to rally. So they're looking for names with specific catalysts. And I think in a lot of investors' minds, Citi kind of fits that bill. They've got a big management realignment going on that should help them to, as they say, sort of bend the curve on costs as we get into the end part of this year, which would allow them to have actually down expenses, which is sort of a real differentiator. Now, the story is really going to have to execute at this point, but I think that's what a lot of investors have kind of rallied around. Quickly,
why underweight on Bank of America?
Bank of America is a great company, unquestionably, but as I think we've talked about in the past, they've had a lot of unrealized losses in their mortgage-backed security. Now, the losses themselves are just not a real investor concern at this point, but they do tie up capital and liquidity, which means, in our view, the company just has an incremental headwind on NII progression that others lack. So a little bit more of a company-specific obstacle than others, but unquestionably a great company over time.
Scott, you got a particular reason for liking KeyBank. It has only to do with the bank itself.
Yeah,
what is it about Key,
exactly
and
right.
Why is that a play here?
Yeah, thanks, Steve. So I actually have a few different reasons. I think they've got a lot of company-specific opportunities. So one, they had gotten kind of sideways with their interest rate risk management over the past couple of years when rates were at zero. And a lot of those headwinds that were, again, very company specific are actually rolling off now. They had a lot of swaps and a lot of low yielding treasuries that they bought. So those are rolling off, and they'll have about a $1 billion revenue benefit that should come by the early part of 2025. So that's an enormous company specific factor. They're also really well geared to take advantage of any capital markets recovery. They've got a good cost outlook that puts them in position to generate positive operating leverage, which most other banks will not this year. And we like the valuation. So we think that's a particularly interesting one as we look into this year and next.
Scott, we got to go, but as the econ reporter, I got to ask you one question. Have banks over-reserved, under-reserved, or are you neutral on the amount that they've put aside for potential delinquencies in their credit portfolio?
Yeah, great question. That's sort of the $1 trillion one. I think they're fine based on what we can see. However, if we don't generate this soft landing, then it's sort of all bets are off.